Hey, good afternoon, and welcome back, everyone, to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're here to talk about a very important but underserved topic that I think a lot of investors really don't spend enough time thinking about, which is arguably one of the most important things for trading. I'm sure everyone here who's watching this webinar today is really has one goal, which is, to grow your trading account consistently and reliably over the long run. But yet, this is the one thing that I think most retail traders struggle with. And a lot of traders think that, the fact that they struggle with trading or growing their account comes down to, factors such as your strategy or the data that you have access to, or who you follow, or who you listen to, or what news channel you watch. And, I've been a strategist for almost 18 years, and I've worked with thousands of retail and institutional investors over that time. And it's very clear to me, what really sets successful traders apart from everyone else. And it's not what strategy you use or what data you have access to or who you follow. It all has to do with two things: risk management and mindset. So today, what we're going to do is we're going to really talk about kind of trading behaviors, specifically, what you really should be starting to pay attention to if you are struggling with growing your account, and just starting to build the framework internally on understanding the actual behaviors that contribute to underperformance and how you can start shifting some of those behaviors into the ones that successful traders have. So that's what we want to cover here today. This is a bit of a two-part series. Today is part one, which is really kind of just even bringing awareness to some of the behaviors that contribute to underperformance by traders. Now, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities that we might mention during today's session. So my goal here today is to try to empower you to grow your trading account and become a profitable trader. Very straightforward. And I'm going to try to do it through two things. Number one, confidence. Understand how your emotions influence your behaviors that contribute to wins and losses, and consistency, building the ability to stick to a trading plan regardless of the current market conditions and your current open positions. Two things that usually have a large effect on people's ability to stick to their trading plan. So we're going to discuss these things during today's session. So, like I said, I have worked with thousands of traders at this point in my career, and I have a pretty good sense of what sets successful traders apart from everyone else. And when I ask traders who struggle with trading, I consistently get um, the feeling that traders who are struggling feel that they are struggling for the wrong reasons. Um, you know, they're always looking for some type of, secret indicator or secret strategy that somehow, successful traders have access to that they don't, right? And there are lots of people out there selling you $5,000, $10,000, $300 a month packages that claim that they have some secret strategy or secret sauce that makes them successful at trading. And if you just pay them, they'll teach you how to do it, or they'll give you access to their strategy. And inevitably, many people pay for these services or pay for these indicators or pay for these courses to teach them how to trade. And inevitably, most of those people who pay for those services don't end up being nearly as successful as the person who's teaching it or claiming how successful those strategies are. And there's reason for that. It's not because those strategies are necessarily not good. It's because strategy alone does not explain whether you're going to be a successful trader or not. What I tend to find is that the traders who are successful are the ones who are able to follow a trading plan consistently, and they're able to regulate their emotions, especially during a loss. Because what I have found is that traders, you can have a strategy, and the strategy it can be a proven strategy that has, consistently delivered results year after year, for, years. But when you're trading that same strategy, you might find results that are vastly different. And it's not because that strategy is necessarily flawed. It has to do with your the emotions that you have to go through when you are trading that specific strategy. And there's no way to transfer that knowledge, that experience of how do you deal with the ups and downs of a strategy. And it's the ups and downs of that strategy that most traders struggle with. And most traders actually do the wrong thing with those ups and downs that actually contribute to underperformance. And one thing that I think is important to note is that, if you look at kind of what's the difference between a retail trader and a professional trader, a lot of people think professional traders have access to, better training, better tools, better strategies, better data. And the reality is that, the vast majority of professional traders don't have access to any better data than retail traders. Arguably, a lot of times retail traders actually have access to more tools, more data, more resources than a lot of professional traders do. But what differentiates professional traders from retail traders is that all professional traders, meaning if you look at anyone who's sitting at a trading desk at a bank, a hedge fund, a pension fund, any of these, any person who manages money professionally in the markets, they all have what are considered risk limits, meaning there's a set amount as to how much they're allowed to risk on any given trade. And the difference between a retail trader and a professional trader, there's only one difference, is that in a professional trader, if you ever exceed the risk limits that your employer or your firm has set for you, you will be fired and you will be out of a job. There's no ifs or buts about it. It is black and white. If you exceed those risk limits, you get fired. As a retail trader, there's nothing stopping you from risking your entire account on a single trade and just, betting it all on black. And that is truly what makes the difference between a professional trader and a retail trader. Think about that for 1 second, right? Because if that is the one thing that differentiates professional traders from retail traders, what can you do to put yourself into the same category and same um, uh, seat as someone who's a professional trader? It's actually incredibly easy. It's just the concept of it is incredibly easy, but what the problem is the emotional um, uh, discipline that's required to stick to these specific rules and never exceed them that most retail traders struggle with. And that's what we're going to talk about here, because it's really easy to come up with a trading plan, but it's incredibly hard to stick to it. And this all comes down to the fact that we're human, and we often make what we consider as very counterproductive decisions, especially when we're placed under stress. So if you have a position if you have a position on, and that position is not going well, and you see a loss on your portfolio, that puts stress on us as human beings. We emotionally are stressed, and we tend to freeze up when we don't know what to do. And this is really where we start deviating away from the trading plan that we have set for ourselves. So in this session, what I want to do is I want to explore these kind of conditions that we are put under, the decisions that we make under these conditions, and what are the right decisions and what are the wrong decisions, and start bringing awareness to you as a trader as to what is contributing to your underperformance and what is not contributing to your outperformance, which are really the two things that I think not enough people teach, not enough people spend enough time learning, and not enough people spend enough time being introspective and actually thinking about what behaviors do you have that contribute to your inability to grow your account in the long run. Okay, so that's what we're going to try to go over during today's session. So in order to do this, there is an entire field of study that's called behavioral finance. It's not a particularly well, um, not that it's not well studied, it's just that it's not a field that's well known. Um, because human beings, what we do is we act surprisingly unpredictable and irrational in many ways when it comes to money. If you look at the study of economics, a lot of kind of economic theory is based on the concept of people are rational people, and that when making decisions, they will always make the decision that makes that maximizes their the financial reward. But what we actually see in the real world is actually many times sort of the exact opposite. We do things that don't make rational sense, like, for example, going to the casino. We know that the edge or the odds are against us. Where it's guaranteed in the long run that you will lose money going to the casino, but yet day after day, millions of people go to a casino and bet their money in hopes that they will strike it big, even though all logical explanations tell us otherwise. That's an example of people, acting in irrational ways, um, or in unpredictable and irrational ways. That we really can't quite understand to sometimes with regards to with economic theory. An example of this is, when you see an item on sale, you buy it despite not needing it, right? Just because it's on sale. Like, we don't need it, but we buy it because it sounds like it's a great deal. It's a great example of like what things that we do irrationally. And there are a lot of things that we do when it comes to trading that we do somewhat irrationally. An example of this is holding on to a stock that's free falling, saying that it has to go back up, right? And think about this, right? How many of you are guilty of this, where you bought a stock, instead of going up, the stock goes significantly lower, and you keep saying to yourself, I'm just going to keep holding on to it because I think eventually it's going to come back up. And it keeps going down, it keeps going down. You keep telling yourself it's going to come back up. I'm just going to keep holding on to it with no real good reason, and you're just frozen. You can't get yourself to take that loss, and you just hold on, and you just hope that it's going to come back one day. And sometimes you might be holding on to that stock for years and years and years before you finally have the mental capacity to kind of just say, you know what, let me let this go. And sometimes eventually, sometimes I know people who have held on to a losing stock for 10 years, and it finally gets back to break even. They say, I'm at break even. Let me close out this trade. And they feel good about that, even though they've spent 10 years locked up in an investment that went absolutely nowhere. It makes no logical sense, but people do it, right? And if you can relate to that, just kind of note that to yourself or raise your hand. So it's important to understand our biases and quirks that influence our decisions, because to trade profitably, we must understand ourselves and we must understand our behaviors, because we're going to quickly learn that a lot of our behaviors do not serve us, and we need to change those behaviors if we want a shot at being successful at trading. Okay, so here's a few things that I think are important for us to think about. Your inability to take a loss and holding on to a losing trade. This is arguably one of the most important things that we need to start evaluating. Because and this part is fairly understandable, right? Like, you put on a trade, you're hoping that the trade is successful, but when the trade goes south, we don't know what to do. And we spend a lot of our emotional capital, a lot of our emotional energy worrying and toiling on all of our losing trades, thinking about what can we do, right? We ask questions to strategists and say, what can I do to repair my losing trade? What can I do to fix my losing trade? There's a lot of energy that people spend trying to figure out what they can do to their losing trades that can turn the losing trades back into a winning trade. And what we're gonna learn very quickly in the long run is that when you see successful traders, this is actually the part of their day and part of their portfolio that they spend the least amount of time on, the least amount of energy on, because when a trade is losing, there's only one thing to do. which is to cut those losers and move on. But people who struggle with growing their accounts do the exact opposite. They spend all their time worrying about their losing trades. They think about their losing trades. They get frozen about their losing trades. And what you realize is that, the reason that you spend so much time on your losing trades, worrying about it, toiling about it, and thinking about it, is because closing out a losing trade is painful. And as human beings, we do everything to try to avoid pain. By not closing out the losing trade, we are sort of kicking the pain down the road. We're saying, well, I don't want to deal with this pain now. I don't want to deal with it today. Maybe I'll deal with it tomorrow. And by not dealing with that pain, that is what hugely contributes to underperformance in the long run. By not just admitting that, hey, I was wrong, this trade did not work out. Let me take a small loss on this trade and move on and focus on my winning trades. Because the one behavior that I see successful traders have that everyone else doesn't have is that successful traders focus 95% of their attention on their winning trades and very little attention on their losing trades. Because, like I said, losing trades, there's only one thing to do. It's to cut those losers and move on. Your winning trades, there are a lot of things that you can do to your winning trades. That's where the market has proven your views are right. That is where you should focus all of your attention on, are your winning trades, to say, how do I turn this winner into a home run? And that is an art, not a science. But when it comes to your losing trades, it's very clear cut and black and white and science based, mathematical based, that you need to cut those losers and move on. Not only do you have to cut those losers, you have to keep those losers small and cut those losers and move on. But this is what most people struggle the most with, is cutting their losers and letting go of it. And if you can start just changing that behavior alone, you will notice a significant improvement in both your mental capacity to deal with your where you should be spending your time on, and your overall performance in your portfolio. The second thing that I see a lot of traders that struggle with is that they take their profits too early. Um, and this also has to do with that first part. Why do we take profits too early? We do it because if we don't take our profits and sometime in the future, a winning trade turns back into a losing trade, that hurts us a lot. We don't want to deal with that potential future pain. So what do? We take profits early. We take profits before we said we were going to take profits, because we just can't deal with the fact that, what if our small winning trade turns back into a loser? We really have a tough time as traders, as human beings, dealing with that. So the way to kind of avoid that is by taking profits early. The first sign that maybe this might not hit your original profit target, or any type of stalling, any type of, where the stock goes in your favor and starts to pull back a little bit. At the first sign of that, we cut our we say, okay, you know what? And there's a saying that you can't go broke taking profits, but you can severely underperform by taking profits early. And these two behaviors are arguably what contributes the most to underperformance: inability to take a loss and taking profits early. And it all has to do with our human being desire of not wanting to either take on pain today or the potential to take on pain tomorrow. And what we do is these behaviors that are designed to kind of protect us and avoid pain, but they actually contribute to most of the underperformance in most portfolios. And this is really where you need to start paying attention to, in your day-to-day, um, uh, as you manage a portfolio. As you pull up your portfolio every morning and you look at your positions, You obviously have some positions that are winning, some positions that are losing. How do you think about those positions? Do you focus your attention on your winning positions, or do you focus more of your attention on your losing positions? And what do you do when you see those losing positions? Do you kind of cut them ruthlessly, or do you spend, all day like thinking about it and worrying about them, thinking about what to do and frozen as to not knowing what to do? And then on your winning trades, do you get nervous and take profits early, or do you just say, hey, you know what? I have to just, even though I'm nervous, I have to just let it play out. I have to let it try to get to my profit targets. You know, ask yourself, do I follow these things, and how do I get myself towards the goal of focusing on my winning trades and not focusing on my losing trades? So today is really just about raising awareness and start building and flexing that muscle of taking a step back when you're pulling up your portfolio and just trying to get a sense for what you're feeling and what you're thinking, what your gut is telling you to do, and start learning, what is the right thing to do and working against what your body is telling you to do. Okay, taking partial profits, losing or adding to a position. These are all other behaviors that we do as traders that contribute to underperformance. Taking partial profits is similar to taking profits early. It's just another variation of that. And when we're losing and we add to a position instead of cutting losses, it's just a worse version of our inability to take a loss, right? And continuing to hold on to it. This is sort of just an even worse version of the first one, of not taking the loss, of adding positions to a losing position, because now you're throwing good money after bad money and you open yourself up to huge exposure. And whenever we look at clients that have blown up their portfolios, it is almost always some type of, where someone has a losing trade and they got themselves into a position where they've lost, quote unquote, too big. And, it's what poker players call pot committed, where you're at a point where you've lost so much money that you really can't, that you couldn't afford to lose, that you just throw Hail Marys at it. And you're saying, you know what, I just got to risk the rest of my portfolio. I gotta make it back, because, if I don't, I really am in big trouble. And, sometimes that works, but many times it doesn't. Many times you end up blowing up a huge hole in your portfolio, sometimes even the entire portfolio, trying to save a losing trade. And if anyone can relate to that, just mark that down and think to yourself, how often do I do this? How often do I do these types of behaviors? Because these are the things that you need to learn to correct. Other things like, this stock is up 20% this week, I better get in before it goes up another 20% next week. FOMO, buying high and hoping that it goes higher. And another reason that some people, underperform is because they're chasing trends that are way too late. Or I've reached my monthly goal, I'm going to take a break. These are all behaviors that we need to start thinking about and understanding. And one thing that I think that isn't another concept that I think is really important to understand, and this is one that really takes a while to sink in. Conceptually, it's easy to understand, but in order for you to internalize it, it takes a lot of time. Is this concept of finite versus infinite games? And some of you might have heard of this concept before applied to other things, but it's absolutely applicable to trading. You might have heard of it being applicable to business or marriage. And there's a pretty famous TED talk that Simon Sinek did on this particular topic, who speaks about this particular way of thinking pretty heavily, especially within the business world and for business leaders. In the 1980s, there was an NYU professor named James Cars who wrote this book called Finite versus Infinite Games. And he was not a business professor or trading, nothing to do with finance or business. He was a religious philosopher. And he wrote this book called Finite versus Infinite Games. And he theorized that there's two types of games in the world. There are finite and infinite games. Finite games are the games that we're all familiar with. Rule of games that have a fixed rules. The game ends at a certain point, and based on those rules, you declare a winner or loser at the end of the game. And the goal of a finite game is simply to win. A good example of this are basketball, football, chess. You play a game, there's rules. The game has to end at a certain point, and based on the rules of that game, at the end, you declare a winner or a loser based on the rules of the game, right? Very easy to understand. We're all familiar with finite games. But he theorizes another type of game called an infinite game. So in an infinite game, there are no agreed upon rules. The game never ends, and there are only players and dropouts. Meaning you either have the resources to continue playing, or you have lost the resources to stay in the game. And when you're playing an infinite game, there's no such thing as winning or losing. You're either in the game or you no longer have enough resources to stay in the game. Good example of this is running a business, right? You can't win at running a business. No one's winning at running a business. You're either in business or you're out of business. So either you have maintained a business that's strong enough to continue, or your business has gone bankrupt and you have to shut down. Or a marriage. There's no winning in marriage, even though I think a lot of people will argue against that. Um, you're either married or you're not married. And trading is the same thing. Either you have enough capital to continue trading one more day, or you've blown up your account and you can't trade anymore. So why do I bring this up is because it's a completely different mindset when you realize that there's no such thing as winning or losing in trading. You can't win. You can't be right or wrong. You either have enough money to continue trading or you don't. And when you realize that and what that means, it has serious ramifications in the decision-making process that you make on your trading. Because what you realize is that you have to make sure that you stay in business as a trader at all costs. That is your only goal as a trader, is to make sure that you don't go out of business. You can't win. You're not trying to win here. You're trying to stay in business. How do you stay in business? You stay in business by not blowing up your trading account. That's your number one priority. A lot of people think your number one priority as a trader is to make money. It's not. Your number one priority is to make sure that you don't blow up your account. And when you realize that, you completely shift your priorities. You can completely shift the way that you think about how you manage your account, how you manage your losers, and how you think about your winners. Because winners will always be there. But if your losers blow up your account, it doesn't matter how many winners you have, you will never be able to succeed as trading. And that's a really, like I said, it's a simple concept to understand. It's an incredibly difficult concept to actually internalize and change your behaviors to actually adapt to this way of thinking. But this is really what, like I said, a lot of traders never even learn this stuff. But it's arguably the most important thing that you have to learn if you want to be successful as a trader, which is why today's session is dedicated just on raising awareness that this stuff even exists so that you can start having the time, and so that you can start spending the time and effort on realizing this stuff and starting to look at this stuff for your daily process as you pull up your portfolio and you're thinking about your portfolio. Because as soon as you pull up your portfolio in the morning and you see those winners or losers, there's emotions that start flowing through you. And sometimes those emotions are incredibly strong, and those emotions take over your behaviors. And what you need to learn as a trader is how to manage those emotions and how to kind of tame those emotions and know what those emotions are going to be and know what you should be doing regardless of what those emotions are. I hope that makes sense to everyone. So there's a lot of stuff that I'm throwing at you right now, but this is arguably, like I said, the most important stuff to learn if your goal is to grow your account as a trader. So here's the thing, right? A lot of options, a lot of education with regards to trading is really focused on a couple of things. Buy and sell signals, meaning how to interpret the market and how to generate entry and exit timing and signals, and trading strategy, right? When do you place your trades to potentially profit from your specific outlook? Most trading education is focused on these two things, technical analysis, fundamental analysis, option strategies, profit and loss, risk to reward ratios, indicators, all of that stuff. Vast majority of trading education is in this particular category. However, I tend to find that, when you see, successful traders, there's the emotional intelligence of trading that is all arguably equally important, if not more important, than your strategy, your indicators, how you decide what to buy, what to sell, that contributes to performance. But yet, this is the part of your education that I find is generally lacking in most places. You can go buy a course on trading, you can pick up a book on trading, and there's usually very little mention, if any at all, on kind of what it actually takes from an emotional perspective to be successful as a trader. There's lots of people teaching you what indicators they use to be successful. No one talks about the struggles. No one talks about the emotional stuff that they're dealing with when they're trading their strategies that make them successful. And because they're not teaching that, and arguably it's you can teach it, but you can't you can't transfer that emotion, right? You can only transfer the knowledge. You can't transfer the actual feeling. And until you've gone through the feeling enough times, it's incredibly hard to actually to do this, which is why, the first step is just raising awareness of this stuff, right? So I always advocate a balanced curriculum. You can't just learn about technical analysis and options and think that you're going to be successful. If you think that's the case, it's a long road to success if you only focus on things like technical analysis, fundamental analysis, strategies, option strategies, and not look at the emotional side of trading. Because trading has a lot of ups and downs. And those ups and downs are incredibly hard to navigate, even with someone who has this knowledge and has this background and is has the training to deal with it. It is almost impossible to deal with it or it is impossible to deal with it if you don't have the training. So today, what I really want to do is try to raise awareness of this and start giving you the tools to start evaluating your own emotions, your own behaviors that can help turn this around for a lot of traders. Okay. Um, the reason that I think it's overlooked by the vast majority of traders is that one, there's limited education on this stuff. And I tend to find that it's not limited in education because people don't want to teach it or no one's teaching it. It's that successful traders are not focused on teaching, and professionals have little incentive to teach, right? They only teach the people who are other professionals. They don't really have an incentive to teach kind of the general public. Um, the second thing is that it's easy to learn, but it's really difficult to internalize. The concepts to understand the stuff are really not difficult at all, but it's really difficult to implement it, especially when you don't have outside support, right? Professionals, like I said, in a professional setting, you have outside support, and you also have the added pressure that if you don't follow the rules, you get fired, right? It's very simple. Like these are rules that have been set, and arguably they're rules that anyone can follow, right? It's to say, okay, if you have $100,000 portfolio and you're placing a trade, you can't risk more than $2,000, 2% of your account, right? You can't risk more than $2,000. As a professional trader, if you risk more than $2,000 on that one trade, you're going to get fired. You're not going to have a job anymore. And if that's the case, you likely will stick to those rules, right? As a professional trader, there's really only one rule, right? And it's risk limits. That's the only rule that's generally put on you as a professional trader. So the only thing that you have to focus on every single day is to make sure that I don't risk more than I'm allowed to risk. If I do, I get fired. And all the people that you've ever heard of, where they've, a bank has lost $10 billion, because of a rogue traders, because they found a way to somehow circumnavigate those risk limits, and their employers didn't find out. Um, as a retail trader, you can set that 2% rule, but nothing stops you from exceeding it. You can exceed it all day long, and no one's going to yell at you or fire you or do anything about it. The only person that you are accountable to is yourself. And it's really easy to just bend the rules when you have no accountability to those specific rules. So really easy to learn, very difficult to internalize. And the third thing is that it requires you to face the very uncomfortable. It requires you to face the uncomfortable. Most humans would rather do the same thing over and over again and avoid pain rather than facing the pain and being uncomfortable. That's just the reality of human beings. We will do everything to avoid pain, even if the process of avoiding pain causes us to have more pain down the road. It's sort of silly, but that's what human beings do. So that's the reason why I find that a lot of traders, may come across this material and never really internalize it because you say, okay, I understand. I follow, all the words that you're saying. I understand. I want to be successful, but when it really comes down to pulling up my portfolio in the morning and kind of being introspective and thinking about my emotions and trying to deal with them and learn how to overcome them, it's just not something that most humans are inclined to do. Uh, it's easier to be set in your old ways and say, you know what, I'm going to blame someone else. I'm going to blame some external factor. I don't want to blame myself. I don't want to say that I'm the reason that I'm underperforming. It's easier for me to say, oh, the strategist that I follow, he sucks. He's telling me to buy this and sell that. He's bad at picking stocks, and it's easier to blame other people than to blame yourself. Um, but that's my experience as a strategist for 18 years is that people don't want to blame themselves. People don't want to do the hard work, so they continue to underperform as traders. So I hope that this session kind of inspires some of you who have been struggling with trading for some time to realize that, it's not that you haven't found the right strategy or you haven't spent enough money on a course, to learn some secret strategy, or you're not spending enough money to get access to the right data points. It's really a lot easier than that. It just requires you to do a little bit of of soul searching, a little bit of introspection, and actually think about, like, when you pull up that portfolio and you see those losing trades, how do you feel? How do you feel, and what do you do as a result of that feeling? And because what you should be doing is pretty straightforward and clear cut. It's just that as human beings, we don't want to do it because like I said, we want to avoid pain at all costs, and that avoidance of pain is actually what causes us to underperform a lot of times. So I'm overcoming these biases. Self-reflection. Take time to regularly evaluate your current and past trading decisions and emotions. Easier said than done, but it's something that, good traders do on a very regular basis, if not on a daily basis. This is not necessarily for everyone. Some people find it useful as journaling and meditation, writing a journal every single day of their positions, all of their positions, what they felt when they looked at those positions, what they did as a result of their feelings. And, over time, you'll start to discover a pattern of what you do and what things serve you well and what things don't serve you well. And those are the things that you need to work on. And it's really an ever, you're never able to reach, um like, no, this is the type of stuff that even the best traders have to consistently work on all the time, right? You never get to a point where you just are automatically doing the right thing every single time. You always will revert back to this, um human nature of avoiding pain and doing the counterproductive behaviors. So it is something that even the best traders have to actively work on all the time. And this is something that I think the best traders are very disciplined on. Every single day, like, before they start trading, they kind of reset their mindset, reset kind of how they do things, and put themselves, quote unquote, in the zone. The same way, professional athletes, get ready for a big game. The traders do the same thing. They have to get in the zone. They have to know, how to behave and how to deal with their emotions When things get stressful, when they get put under pressure, that's what differentiates good traders and good, professional athletes from everyone else. And lastly, position sizing. We're going to talk about that a little bit more in the next session. But position sizing is arguably one of the biggest things that you can do to put yourself onto the right path of being in the right mindset. Position sizing can make the dealing with the emotions a lot easier if you size your positions correctly to begin with. And we're going to talk, like I said, about that a little bit more on our next session. With that, that covers what I wanted to share with you here today. Like I said, this is really heavy stuff to some degree because it requires a lot of introspection. Um, but it is arguably the most important lesson for you to learn as a trader. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, there's a Q&A button at the bottom of your screen. Please type your questions into that Q&A box, and I'll try to answer as many questions as I have time for today. Looks like I have one question in there already. When is the losing add to a position okay versus bad? I.e., what about dollar cost averaging strategy when the price goes up and down a lot? So dollar cost averaging is quite different from adding to a losing position because dollar cost averaging is a long-term investment strategy. And I would argue that dollar cost averaging does have a limit to it as well, right? So for example, if you buy some stock when it's at trading 100 and the stock starts to dip, you can buy some more. And the whole point of dollar cost averaging is you want to buy something over a long period of time. But if you have $100 stock that's now trading at $20, do you want to continue dollar cost averaging, right? So here's the thing about dollar cost averaging. Every single time you choose to buy that stock in the future, right? So, you buy it at 100, you buy some more at 90, you buy some more at 80. Every single time you make that purchase, right? You have to ask yourself, do I think this is a good investment, right? You don't just dollar cost average for the sake of dollar cost averaging. You should every single time you're buying more, you should have an investment thesis in mind as to why you're buying more. And as long as your thesis remains intact, that you believe that there's a long-term viability for this particular stock, then you can continue to dollar cost average. But I would argue that there is a point at which some point where you might say, hey, I don't think this is a good investment anymore. I thought it was a good investment at one point, but clearly new information has come out, right? That maybe, when you bought it at $100, the stock was growing at, 15% per year. And, based on some new, maybe some new company has come out and has started taking market share from them. Maybe they started doing some stuff that, increase their input costs and their profit margins are down. Maybe they've launched some bad products. Whatever it is, some new information has clearly come out where it used to be $100 stock. Now it's $50 stock. So you have to reevaluate every single time you're dollar cost averaging to say, do I still think this is a good investment? And like I said, I would argue that at some point you might want to say, hey, this is no longer a good investment, right? Like at $100 it was, at the time the company was doing great. Now the company's not doing so great. I don't think this is such a good investment anymore. I should not continue to dollar cost average anymore. So there's nothing inherently wrong with dollar cost averaging, but you do have to make that decision as to whether or not it's still a good investment or not. That's a little different than adding money to a bad trade. Adding money to a bad trade is basically, I think the stock is, bought it at 100. I think it's going to go to 150, but it's now down to 75. I'm just going to buy some more because I really just want to get myself back to break even at a sooner. That's an example of throwing good money after bad money, which is, like I said, a little different than dollar cost averaging. How do you know when you are exiting a trade too early? Great question. There is no one method to do so. So here's the thing, right? It depends on your strategy. Each strategy has arguably most strategies have a set exit point, right? So depend, and usually that determines like it depends on why you got into the trade, right? So for example, if you're basing the trade based on technical analysis, then you should use the same technical indicator to plot some form of an exit strategy. And so for example, if you have a technical based entry point, then you should have a technical based exit point, right? That's kind of your that's so it's strategy based. If let's say you're buying a stock based on fundamentals, then you should probably have a fundamental based exit point. If you're buying your stock because of whatever strategy that you're using, then that strategy largely should have some form of an exit point. I would argue that a strategy that doesn't have an exit point is not a strategy. So think about like why you got into the trade, and usually the reason that you got into a trade also will provide you with some insight as to why when you should get out of that trade. What are the rules for cutting losses and taking profits? Also, a fantastic question. The rules for cutting losses should be incredibly black and white. Meaning, when you get into a trade, you should know exactly at what point you consider yourself as quote unquote wrong on the trade and getting out. And those rules should be, like I said, black and white. There should be no, oh, it depends on this or it depends on that. You should know exactly when you get out, and it should be very black and white. And it's designed that way to remove the emotional aspect of figuring out when to take losses or how to take losses. Because if you buy the stock at 100 and you say, hey, if it crosses below 80, I got to get out, it's black and white, right? The stock is either above 80 or it's below 80. There's no ifs or buts. And that determines whether you get out. So rules for cutting losses should be incredibly simple, clear cut, and easy to follow, where it requires zero emotional thought or effort into deciding whether or not you should cut your losses. That way you can kind of keep things really, really simple and requires no mental energy to decide whether or not you should cut a loss. On the other side, when do you take profits? That is where you should be spending a lot of your mental energy on, because once a trade is profitable, you have a lot of different choices as to what you want to do there. So, for example, you bought a stock at 100, it's now trading at 120. Now, what should you do? Should you roll your trade? If you're trading options, should you buy some more if you're buying stock? Because that's where the market is saying, hey, your views are correct. Let's see if we can turn what is a correct view from a small win into a huge home run, right? You thought this was a good investment. Clearly the market agrees with you. Let's see if this can continue to run, right? Because that's really where you have the opportunity to hit home runs. But going back to the finite versus infinite game concept, right? You don't have the ability to hit home runs if you've blown up your portfolio, which is why your number one goal is to prevent yourself from blowing up your portfolio. And as long as you continue to prevent yourself from, as long as you stay in business, the upside opportunities will continue to present themselves over and over and over again. Because guess what? You always have capital remaining to continue trading because you've maintained cutting your losses appropriately so that you always have the opportunity to take risks in the market. And sometimes those risks pay off and sometimes they pay off big. But those you can only capture those big payoffs if you don't blow up your account in the first run. So that's why the concept of finite versus infinite games are incredibly important for traders to change their mindset and actually think about what's more important. A lot of people think the upside's important. The upside's not the important part. Managing your downside is far, far more important because you have a finite amount of capital to risk. Um, there's an infinite amount of capital that you can capture the upside, but there's a finite amount of capital that you can risk. So it's all about protecting that downside so that you have the opportunity to capture the upside. Um, This question here saying, hi, thank you for the insightful webinar. Are there any resources you would recommend to help us better understand the broader context of today's unstable global landscape? Um, I actually think a really good book slash video series on this is Ray Dalio's New World Order. I think it's a pretty good study of history and the analogies of what we're seeing today with kind of what has happened historically. I think is a good starting point. When to add more positions? I'm not sure I understand that question. I think I need a little bit more context if you don't mind there, Lee. Um, uh, Biren is saying this is not a question, but feedback to all brokers that they design built-in risk management at full portfolio levels and also individual trade level on the order ticket itself. It will help most retail traders from hurting themselves. So this is really where we have built some of this exact functionality into options play. We've built this specifically for this purpose. Let me just bring this up here so I can show that to you in 1 second. So when you log into your first trade account, here, let me do this real quick. When you log into your first trade account, when you use the options play tool, which you can first find by either on your homepage going to the options wizard button here, or if you go to options trading, you will also find the options wizard under options trading. But in the options play platform, we have what's called the risk and investment calculator. So this is sort of pre-order ticket. So whenever you're looking at any strategy in options play, and I'm going to use an example. Let's say you have $100,000 portfolio. The rule of thumb, and we're going to cover more of this during the next session, is that the rule of thumb is that if whatever your portfolio size, you should never risk more than 2% of that portfolio value on a single trade when it comes to options. So it doesn't matter what strategy you're looking at here. Let's look at, for example, T-Mobile here. Let's say you have a bearish view here on T-Mobile. You use your risk and investment calculator, which is right here. And what you want to do is you want to plug in the dollar amount that you have to risk. So you can calculate that. I'm sorry, first of all, you want to do I want to risk $2,000 because that's 2% of a $100,000 portfolio. And what that will do is it'll calculate for you the appropriate number of contracts, okay? Let me use a smaller price stock to kind of give you a better sense because each contract there was basically $2,000. Let's look at Archer Daniels. Let's say I want to buy this call option here. I would use the risk and investment calculator. I would click on I want to risk and click on $2,000. And what it does is it calculates and tell me I can buy 4 contracts of it. And if I bought 4 contracts, my max risk will be $1,760, which is within the $2,000 maximum risk that I've determined, right? And this works for all strategies. So that when I go click on the trade button and preview order, what it does is it pre-fills my order ticket with the 4 contracts already pre-filled in the order ticket. I'm not sure why that didn't come through, but it should pre-fill your order ticket with the appropriate number of contracts. So we have tried to build these types of features into options play. So as you're doing your analysis, you have a contract calculator that kind of puts you in the right lane with regards to these types of things. So great suggestion. But that is a tool that you have access to at your disposal at First Trade. What's your take on quant trading, especially the way it takes emotions out of decision making? I understand the attractiveness of quantitative trading. I just think that quantitative trading is an incredibly difficult thing to set up. It requires a deep amount of knowledge of strategies to even, number one, be able to kind of back test and feel comfortable with a quantitative strategy, like a fully autonomous strategy. And then it takes an incredible amount of effort to manage and maintain a quantitative strategy as well. And what a lot of people don't really kind of realize and think about is that a lot of times you look at kind of back tested strategies and you see like an equity curve that beats the S&P 500 or beats like a buy and hold strategy. What people don't really realize is that like trading strategies don't just go straight up, right? Like even if you have a great quantitative strategy that in the long run has proven to be successful, there are always periods that, the strategy doesn't perform so well. And sometimes those periods can last for months, many times years. And, and there's nothing that tells you whether or not you start your trading at a time where, it goes up or it trades sideways or maybe even goes down, so even the most successful strategies, if you look at those back tests, if you were to enter those strategies at kind of the worst times in terms of market conditions, it could be 2 years before the strategy actually turns profitable. And most people don't have the mental resolve to continue trading a quantitative strategy for 2 years, seeing kind of no results and just keep doing it every single day and every single month and just saying that, I think ultimately it will turn back around. People have really short attention span is not the right word, but people have really short um a tolerance for underperformance. But the reality of trading is that even the best strategies sometimes have periods of months, sometimes years, where you don't really see any real performance. And then a couple of years, you can have a couple of straight years that just you go gangbusters, month after month, and then sometimes you go into another period of kind of quiet or sideways or even a little bit of pullback, and that's the nature of trading. There's no and that's the part that people can't prepare you for emotionally. Like, what does it feel like to trade a strategy for 6 months and see no results and know that you're just going to keep doing it day after day? People don't have the mental resolve to do that. A lot of people don't. And that's, again, what separates successful traders from everyone else. Successful traders know that have confidence in their strategy and they stick to their strategy, even though if in the short run it's not working. But I find most retail traders, if the strategy is not working for even a month, they say, "Oh no, this isn't for me. I'm canceling my subscription. I'm moving on to the next one. This guy sucks. I'm going to subscribe to someone else who I think is better." And inevitably, you just repeat that cycle over and over and over again without ever finding long-term success, because no strategy is successful month after month, every single month. It just doesn't exist. And if you think that it does, I'm sorry, but I hate to burst your bubble. It just doesn't work that way. So quantitative trading, I'm a big fan of it, but you have to be realistic as to what it actually provides. And a lot of times it's not as sexy as you might think. Um, is there any other ways to keep on track beyond journaling of my own trades? Um, I'm not sure what you mean. Journaling is probably the best way to do that, in my opinion. How do you put a stop on an option? Great question. That's a question that I think you should direct at your broker at first trade, to have them walk you through placing stop orders on your option strategies, just because I don't have any positions to show you how to do that. I'm interested in the wheel option strategy. Thoughts? The wheel strategy should probably be the most core strategy to your options or investment portfolio. It is a strategy that basically anyone who has a long-term investment portfolio should be using and utilizing to generate additional income and yield for your portfolio. I'm a huge fan of it, and I think that that is actually where the vast majority of options traders should be spending most of their time on, are in strategies like the wheel strategy. Need to add more positions when you are making money on this stocks, like double down when you're right to max profit? Exactly. What risk management tools would you have for the wheel strategy? Um, the only risk management tools that you really need for the wheel strategy is, on the short put side, right? Like, at what point, if you sell a put option, do you decide that, hey, you know what? I've got put the stock is down. I got to cut my losses and move on. There's really no risk management that you need to do on a covered call, right? You only have to do it on the short put, or if you get assigned on the stock and the stock goes lower. That's really where you need to focus on. How do you mentally turn around your trading if you have a few days of positive growth and then one day that takes it all back? Even with good risk management, losses can mount until consistency returns. Well, I mean, first of all, you shouldn't have one loss that wipes out multiple days of gains. If that's the case, then it sounds like you're risking too much, or you're taking your profits way too early, right? Which is again the whole point of this discussion, which is what behaviors contribute to this, right? So if you're having multiple days of gains being wiped out by one loss, then it sounds like you're doing exactly what we said at the top that you shouldn't be doing, which is taking profits too early and letting your losers get too big. You should be doing sort of the exact opposite, which, like I said, is easy, much easier said than done. Uh, this question is an interesting question. Just like the stock LEU, which I'm not familiar with that stock, I bought 100 shares at 120, but it keeps going up to 180 now. But I didn't add more positions, so I regret now. What should be the strategy of maximizing profit when you get into the right stocks? So, I mean, it really should have been, when you had a $120 stock and it went up to 140, 150. You should, in theory, and it's easy to say this in hindsight, is that you should try to buy some more in the stocks that are going well, right? And how do you buy more? Is you cut, when you cut your losers and you raise some cash from the losing trades, you roll those the cash that you have from a losing trade into the winning trades, right? That's where you should be allocating more and more of your capital, is in the places where the market has proven you to be correct. And yes, that might sometimes mean that you buy some more at 150 and the stock drops down to 130. And now you basically are flat in your entire position. That happens all the time, right? But that's okay if you end up being flat because at least you took a shot at hitting a home run. And guess what? Occasionally you will hit that home run, and now you will have made triple the amount of money that you originally thought you were going to make when you do hit those home runs. And as long as you continue to keep your losses small and contained every single time you have a loss, that is how you're going to outperform in the long run. Okay, we're gone over an hour here. So that is all the time that I have here for today. Like I said, I really hope that this illuminates for a lot of you who are struggling with trading, like just a whole different curriculum that you may not even have thought existed, that you need to really spend some time on understanding and internalizing. It's not easy stuff, but it is stuff that's very, very important, which is why I'm doing this session. And I'll be doing more on this session here in 2 weeks' time on risk management, which is kind of a direct second piece to what we're discussing during today's session. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.